Let's start with the GDP numbers out so far in France in particular. When we hear slightly better than expected numbers like this, does it change your outlook at all for the core of the Eurozone?
Well, it's of course a boost to sentiment, that goes without saying, because up until now we had basically seen a significant pickup since the lows of November 2012 of the confidence indicators, the PMIs and the leading indicators of the OECD. Now that you have the real data, activity data confirming that picture, that's a boost for sentiment. It's also important going into the European parliamentary elections in May this year.
But do you expect this sort of strength continue? Is it sustainable in France?
Well, you have to analyze it, the numbers, of course, in more detail. One of the issues that we have is that there have been specific measures which have given a boost to car sales. So these are typically the more short-term things. What you do have to hope, of course, is that that in itself is then going to create some follow-through. And that indeed activity would continue to grow and GDP would continue to grow. Looking at the evolution of the PMI numbers in Europe, that is of course also what you would suspect. On the other hand, what you see is that coming from the US, there's a bit of headwinds now with some slowdown, so that is also going to be a factor to take into account and could lead to a bit weaker reading in the coming months at the Eurozone level.
What is your strategy, your investment strategy for Europe now, for the core and the periphery for 2014?
Well, on the periphery, on the bond side, we've seen, of course, a phenomenon of positive contagion, if you can put it like that. Ireland became the darling of bond markets. Spain already was. Then Portugal very much became, it's perhaps fit to use that example, to that metaphor on Valentine's Day. And now even Greece is being looked at with great interest. I think that will continue, although again, going into the parliamentary elections, that could be some hold off, people wanting to know how the elections turn out and whether there would be more extreme votes. On the other hand, on the equity side, we still like the market. There's very good potential of earnings growth, more than in the US, for instance. So we definitely want to be overweight there.
How are you playing emerging markets, given the rout we've seen over the past few weeks? And how do you expect that to play out now?
I think there's excessive pessimism. I think it's we have had a series of storms, but it's not a crisis. What we've seen is that it's not a homogeneous block, so there's a lot of diversity between the different markets. What you also see is that there has been a forced adjustment to the detriment of domestic demand and to the benefit of export demand. That will lead to a swift improvement of current account deficits. That has been a major concern. Monetary policy tightening will keep inflation under control. So I think we really need to look at positive catalysts kicking in to justify going back into these markets. For the time being, we hold off, but it is certainly something that we are monitoring very closely.